Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
All right, good morning, everyone. March 26th. Just a really quick update on Cane Island, and then some numbers, fresh data from Telmax. Just as a reminder, no direct investment advice here. Any securities talk like that, come in and speak with us. So Cane Island is one of several Class A garden style multi-res deals that we have in the real estate fund. This is, maybe 40% of the fund is stuff just like this. And Cane Island, I think, is one of the bigger properties. It's really nice. It stabilized earlier this year, like in January, and so took out a second mortgage and kicked out an equity distribution to us. So very pleased with that. And then these are just pictures. It's in Florida, so you can check out Cane Island. And if you want to rent a place there, go nuts. So Telmax is picking up the pace here. There's these slides are a little bit grainy because this is sort of their actual stuff that the leadership team looks at, and residential installs a little bit ahead of target. The average residential installs on a sort of last rolling 7-day basis looks like it's come down quite a lot, but then again it should, because that's the winter, and so when the ground freezes, it's a little bit harder to put in fiber optic cable into people's homes. So this is not a problem or an accident. This actually happens every winter, and this year in particular it was pretty cold. So a lot of the regions had frozen solid ground. But you can see, kind of coming into mid-March or so, it's starting to trend back up. So we should see that improve dramatically as the temperatures do as well. I think the main slide on this page is that install success rate. So they're kind of aiming for 90%. Seems to be a good number, and certainly the weighted average is clustering around that line, which is positive. And again, the dip down lower in late November, December, and January is once again the impact of the cold weather. So they are making progress, and what tends to happen is you'll see more of this line kind of hugging that 90% target rate throughout the summer, and it should actually kind of go a little bit above 90% because they have secured more crews to. If you ever seen one of these fiber optic cables being delivered to a community, it's just a big telecommunications truck with like a big spool of fiber optic cable on a trailer out back. And once they're plugged into your home, they got you. So the residential churn rate, top left slide, has really been sort of trending towards, I would say, that level of just below 1%. It almost touched 1%, but has come down. It's certainly not an issue. I think the one for me is that residential customer count. Looks like there was a little bit of a gap forming between their target rate and sort of where they're at in real time. These are fairly live numbers. You can see those last two bars are January and February of this year. So I'll just have to, ask the CEO what's up with that, and also if you look, I can sort of see it, but that the actuals bars seem to be flattening. So I don't know if that's sort of seasonal or whatever. So we'll find out about that. The product mix is really the lion's share of it is that two gigabyte product, and ARPU is trending nicely higher. So that's obviously a good sign for this kind of company. Penetration by municipality, way up at the top is Stouffville, where the company was sort of started off at, and they're pretty much a third of the town of Stouffville. And I say sort of town because to me the much more important line here is that dark line, which is Newmarket. Newmarket is about 5 times the size of Stouffville, and so it's important that they certainly have market penetration, but it's really in these bigger cities like again, Newmarket, Aurora, certainly Richmond Hill and Markham. Richmond Hill and Markham are essentially gigantic when you compare them to Brooklyn, which is a lovely, lovely town. I drive through it often, but it's small, and so you can see they're sort of just trending higher there now. What else can I say? The Barrie line, I think, is got off to a really, really good start, and it's sort of flatlined. So we'll just have to see what's going on in Barrie. But you can really get a sense that they're targeting these outside of the kind of core GTA markets. Richmond Hill, you could say, is still kind of like the real north end of Toronto. Same with Markham. You could say that's sort of like north Scarborough, but it's progressing forward very nicely. I mean, I would love to see all of these penetration rates kind of between 20 and 30%. Network availability on a rolling 3-month basis has been, outstanding for the most part. It's pretty much right up near that 100% line, and serviceability and costs seem to be okay. The cost is just sort of trending a little bit above target, and I haven't really looked into exactly what that represents, but it might be certainly more recently things like the cost of gas, but other inputs as well, like the hourly pay rates for these crews. It is a bit of a process putting these into the ground, and then just the forecasts in terms of serviceability by municipality and phase. I think with this company, it got started off in a very good position, and just sort of rolling back. How we came across Telmax was the CRTC through a request by the city of Oshawa granted Telmax a kind of like an express regulatory approval. It's actually pretty hard to get a telecommunications company set up in Canada because of regulations, Oshawa came out and said, we need help. Our internet and this and that is slow, and it's not high performance enough, and we need to do something. So they got off to a pretty good start, and then I think for a year or two maybe they were kind of not really stuck in neutral, but maybe sort of spinning the tires a little bit, and that's when Mike Stropel, the current CEO, came in from Allstream, and I think Mike really knows what he's doing. He is obviously setting this company up for an exit, and he is, well on his way. I think he's also very well aligned financially himself to position this for a sale. The sort of whisper is that it'll be sold to, guys like Omers or someone like that. It may not necessarily be Rogers or BCE that swallows these guys. But you never know. They might be a big enough pain in the where that Rogers says, what, we'll take it. In terms of charts of the week, I think the idea here is really all about oil and whatever Trump is saying in terms of the next steps in Iran. And it seems like that series of tweets and stuff is sort of changing by the hour. So I really don't know what to say about that. Andrew, for his part, is sort of disencouraging people. Like, if you haven't gotten into oil now, he's kind of saying it is kind of risky to do so at the current levels, given that they've, come up a bit. And here you can see his risk on, risk off indicator is sort of in the risk off zone, meaning that, he thinks there's, potentially an opportunity for intrepid investors to, take a stake here. But if you're sort of on the, more conservative side, you might want to watch it. And that brings me to the S&P 500, which, in recent weeks has, spent a little bit more time than we've seen in a while down in this oversold territory. So that's turning into, a bit of a situation there. It has actually broken through the second, or third, standard deviation of the 50-day. And so, deeply oversold relative to its technicals. This downtrend channel that he highlights here goes back to last month, and I think the idea here is he's really kind of focusing on those lower support levels, kind of in that 6150, 6200 range. He's not, in the essay portion, he doesn't go out and say that he has a lot of confidence that we'll get there, but rather he certainly talks a lot about these lower support zones being there. So it's like he's not saying the market necessarily is flashing signs that it's going to get down there, but then he says, but if wink wink nudge nudge, when it does, it'll be hopefully supported. So I'm not really sure where he was going with that. On the other hand, this particular graph is a lot more clear, and this is the percentage of stocks on the NYSE above their 50-day, and there's not that many of them, and so technically, some of the damage from the sell-off, which looked a little bit slower and more grindy, I guess you could say, has actually created a situation where a lot of these stocks now are below their 50-day. And even though you've seen, early signs of a reversal due to the amount of sort of technical damage done, it still has, a ways to go before, you sense that confidence in stocks. So oil. So what does he say about oil? It's definitely calling the shots right now. It's probably the most talked about, commodity. It might be the most talked about anything right now. And these gains in oil have tend to come at the expense of stocks. And that's, a relationship that I think he still seeks some clarity on. Clarity being, what happens in Iran. Sounds like, and again, I was tied up in other matters, but it looks like Trump's wanting to, start some discussions. And then, the Persians have said, no way you started this. And, there's all kinds of stuff going on. And so that sideways range has created a situation where you've got oil kind of going from, let's call it the mid 80s to 102. And, again, just based on the fact that it's moved kind of a lot to the upside and then sort of, I guess, ricocheted in between this fairly broad channel. It's almost a $20 wide channel there. He is advising people who aren't in oil right now to maybe just kind of watch and watch from the sidelines. So here's gold, and it's come off quite a bit here. That's sort of a perspective thing, because of course a lot of people are calling us and saying, how come gold is going down when there's a war? And it's like, well, because it went up, I don't know, 300% before the war even started. So there's some kind of mixed, not really mixed messaging. The technicals actually look very clear, right? So he's got some Fibonacci lines painted on this chart, and that dip down below hit sort of right on the buzzer, the 38.2% first Fibonacci retracement line. So this is sort of a textbook, you know, counter cyclical move in gold. It's hardly a situation where non-gold bugs can come out of the woodwork and say, aha, it's just a metal, it doesn't pay a dividend or rent, I told you so. It's not about that. This is just sort of purely a classic technical pullback, and it's just made so much more confusing by the fact that again, the run up in gold happened before the war in Iran started. So just sort of pointing that out there. And then banks. So this is really interesting because we haven't talked about this KBW Invesco banking ETF. And, this is why it's sometimes important to periodically, take a walk around various sectors and see what they're doing. But it does point out here that this banking ETF did get some pretty good support. Mainly, it sounds like as a result of a proposal to roll back some of the higher tier one capital impositions that were put in place following the global financial crisis. So what could go wrong with that? But the stocks liked it. They hit a support zone sort of in and around the same time as this proposal got tabled. And we actually invested in an LP that is kind of heavily into the banks. So we'll have a discussion with them in the coming weeks, and maybe able to contribute to the discussion a little bit more from the fundamental side. And then the Magnificent Seven. So this is the Round Hill Mag 7 ETF. Let me just X out of this screen here. It's rolling over, but you see at the bottom that relative strength panel. So that's a positive divergence, and so he thinks you could see a bit of a bounce here. And it has pulled back to an area where it broke out to new highs last summer, but of course it was last summer, and so I think you want to be careful with that. And I think that's it for me, David. Yeah, it is. Awesome. Thanks.
Hey, MAAM weekly research meeting. Just going over a typical report, March 27th. First of all, disclaimer for Canadian investors, just contact your financial advisor or planner if you have any questions regarding this, or email us at info@mcnickelasset.com if you have any questions, and you can speak to one of our portfolio managers. Same thing for our U.S. listeners. Just contact us if you have any questions, and we're not providing any tax advice as well. Quickly looking here at the S&P 500 4-box slide this week. 2 new sell signals. That's 3 straight. That's the first occurrence since last spring. There's no short-term support anymore. The Iranian instability and investor uncertainty continues to lead the market. Year to date, market's down 6%. You blinked and you missed it. It is below the 150 and 200-day moving averages now. Momentum is broken down on a weekly basis over the last few months. We are on the longest streak since 2023 for that metric. And then the overbought oversold, the lowest week since last April, 97% oversold. It's the 4th week in a row it's been heavily oversold. And on a trailing 12-month basis, S&P 500, I would say, is still kind of expensive at 27 times earnings. Looking here at the NASDAQ, 5-box decrease week over week, 2 new sell signals, 4 straight. That's the first time since 2022 the NASDAQ has had 4 straight sell signals. It didn't happen last year during Trump's tariff tantrum. You can see only 3 there. Happened in 2022. It's down since September, erasing multiple months of gains, obviously, down about 7% year to date, below the 200 and 150-day moving averages as well. Momentum breaks down again. Overbought, oversold completely. Third straight week it's been heavily oversold, and 8th straight week it's been oversold overall. Most components are close to down to 10% in March. That's really being driven by the mega caps and the AI hyperscalers who are seeing their stock prices move down the most. On a valuation standpoint, it's decreased a little in terms of forward earnings, but nonetheless still elevated relative to historical averages and other major global indices. Looking here at the Dow, 4-box decrease week over week. That's the 6th straight sell signal it created. That's the most since 2015 in a row. So some real sustained weakness here for the Dow. Negative trend officially, trading below its 50, 150, and 200-day moving averages. Tech and financials have had heavy reversal this year. Through the year, Microsoft's down 26%, NVIDIA 10%, CRM 32%, Amex 21%. Most of the major financials are down this year. All of the tech stocks basically are down more than 7% this year within the Dow. So real weakness we're seeing there. Iran sell-off has obviously flipped March's momentum to negative. And then the valuation, it's gotten cheaper with the pullback in the price for the Dow, but still trading above 22 times earnings on a trailing 12-month basis. So something to watch there. TSX 60 here, 3-box decrease week over week. New sell signal. That's the 2nd straight. It's now flat year to date. Looks strong from a valuation standpoint, but now this market pullback that we've seen impact a lot of the U.S. for the most part, and has impacted some Canadian companies, is really trickling out, and I guess you'll call it a global contagion almost. And the TSX is displaying some real technical weakness that we're really being mindful of right now. Overbought, oversold by about 32%. That's the 2nd straight week we've been oversold. That's the first occurrence since last April. So really we're seeing, like I said, a breakdown in the TSX slowly. These other U.S. indices, completely negative trends, I would say. But the Canadian market slowly moving towards that. We'll have to see if that continues in the next few weeks. VIX popped up about 9% this week, returned to a buy signal after creating a sell signal last week. The target moved up to 50.5%, and this exponential upward trend continues. I had mentioned it going on 2 to 3 months now. It just continues to move higher. We'll have to see if we can test those highs at 35% in the coming week that we saw just a couple weeks ago. These technical indicators really just reversed a little. S&P 500 showing some real weakness, down to 34%. Percent positive trends both moved down this week as well, but still elevated as they're more lagging indicators. And then the TSX, both of these indicators moved lower. Bullish percentage chart for the Toronto Stock Exchange, which had its most strength in going on 8 years, really just has reversed in the last 2 months, despite a lot of energy names within the TSX pulling the TSX to a flat return year today. But obviously those two charts have more to do with breadth than anything. Looking here, asset class rankings, a lot of movement. Commodities pulled back, driven by precious metal weakness. Every other asset class picked up buy signals. Energy picked up another 20 this week within the sectors. Really showing, you can see the spread there of 52 buy signals from energy to industrials, and then even more when you drop into these tech indices. I'm just surprised that tech and communication services are still elevated, and we haven't seen an increase from utilities and even basic materials. But a lot of changes that we've seen in the last few weeks, and we're allocating accordingly. Now, I didn't say anything. International equities at the top of the chart, but it's not because of the regions that you would typically expect to be the leaders in the international equity areas. Obviously, Canada right in the middle, and I said Canadian markets pulled back in recent weeks, but over the last year and a half, we've been a very strong market. But it's not the likes of India and China and even most of Europe that are pulling the market along. It's predominantly, Latin America, ex-Mexico recently, and South Korea, the best performing market really over the last few months. In the world, we are allocated toward both emerging markets and South Korea. We want to monitor both markets very closely, but just some changes that we've seen in the recent weeks that we're watching very, very closely, I would say, and we'll have to see if anything changes coming. Couple more charts. This is just the price of copper. Copper pulled back, obviously, no surprise with what's going on in Iran, instability, global economic worries. A bit of a pullback after that really explosive September to mid-January period where the price of copper really surged. So if you have limited exposure, perhaps it's an entry point right now to look at. And then here's the copper to gold ratio, which has been in decline since 2022. No surprise, gold has surged in price. We'll have to see if this chart can reverse. You can see historically, the copper gold the copper gold ratio moves pretty quickly, but there are these multi-year periods where there is an outperformance from one of the asset classes compared to the other. So we'll have to see if this trend does reverse, and you should rotate some potential capital from some of your gold holdings into some more in industrial metals. Last two slides, I'll be very quick this week. Private credit. You can see here, this is a chart from Bloomberg. Their calculations of redemptions and then unmet redemptions. So where they're seeing redemptions in their private credit funds is the orange. So about 9 to 12% of their assets, and these aren't small funds. It's Cliffwater, Ares, and Apollo, some of the largest private asset managers in the world, and they're only meeting about half of those redemption requests right now. So we'll have to see if that improves in the coming months or coming quarters when more redemption requests are made, or that's a continued trend that we will have to obviously price into the market. And it's obviously not just private credit funds. In Canada, we all know a lot of these real estate funds are gating and they have no liquidity. The real estate market, especially the non-residential, is very slow right now. And that's forced a lot of asset managers to put up the gates, suspend redemptions. UBS also doing that. It's about a €400 million euro fund based in Germany. And they've told their LPs that they will not be giving any redemptions for 3 years. So imagine if that were that problem were to scale and increase in the private credit space, or even in some of the North American real estate markets, how worried many investors would become. And then this is just a chart that I think Bloomberg put out in an opinion article this week that really explains why people are worried about private credit. For years, 12 years, 2013 to 2025, private credit was a growth engine for Wall Street. Fast forward to today, and investors are worried. Why? Because a lot of the private credit firms are overexposed to classic IT companies, software companies, and there are worries that a lot of these assets are not marked to market. They are just dragging with their feet when they're marking their NAVs, which could really impact returns if there are some serious problems under the hood. But there is worries that AI is going to lead to a lot more of these credit loans that these private credit firms are extending to firms are going to begin to default. And you can see here, X Energy, the default rates have been historically low, and that's why the returns have been so attractive in private credit. It's why it's been such a strong growth area for Wall Street and asset management. And if these tick up, not even double, but a couple 100 basis points, we could see some significant changes which will impact obviously not just high net worth individuals' investment portfolios, but also many of the middle class who have exposure to these liquid alt strategies, or even the pension funds that are exposed to a lot of private credit and a lot of private assets. So something really important to watch in the coming weeks to months is how this how these private credit issues shake out, and we'll have to see what happens. And I think that's it for me this week.
Okay, hopefully this audio will come through.
Good morning, everyone, and welcome to this morning's brief update for March 26, 2026. My name is David Clark. I'm the analyst here at NASDAQ Dorsey Wright. Taking a look at action from yesterday, mostly positive for the indices we follow here. Did see crude dive back a little bit as it pulled back over a little bit, 2% there, but even see it rebound this morning. Gold was up about 3%, but also seeing a pullback this morning. International equities in positive territory. U.S. equities in positive territory, led the way to the upside by the Russell 2000. Looking at individual U.S. equity index charts, we do see the Dow reversing back into X's, forming a potential buy signal. It takes a move above 46,800 in order to return to a buy signal here, but we at least see a higher bottom put in place, sort of a near-term silver lining on the chart there, if you will. As for the Russell 2000, saw it further uptick on its chart, moving back above 2540. At the moment, it takes a move above 2600 in order to return it to a buy signal, as well as potentially flip it back into a positive trend. Decent amount of indicator action. Worth noting that we've seen a reversal up in the 10-week for the NYSE above 30% here, so showing that at least we're seeing an uptick in stocks moving above their 50-day moving average. Similar action for the 30-week indicator for the NYSE here, also reversing up, so we're seeing action there. The stocks moving back above their 150-day moving average as well, and also starting to see some bullish percent action as we saw the bullish percent for the S&P Mid Cap 400 reverse back into X's to 42%, and the bullish percent for the S&P Mid Cap 600 or Small Cap 600, pardon me, reversing back into X's as well at 44%. So small and mid cap seeing some of those stocks return to buy signals. We're also seeing those stocks, some of them move above their 50 and 150-day moving averages. So starting to see some slight upticks in the indicators. Google being one that you might see in quite a few headlines this morning. Not major price action move, but just quite a few headlines involving Google, whether it being a new process in terms of AI. That is a headline we've spotted. Another one being a potential case within Meta that they're involved in. So it's quite a few headlines out about Google this morning, but we're just taking a look at the chart here real quick. I've seen 4 consecutive sell signals here. Haven't seen quite the potential of it like we've seen some of those other U.S. equity index charts moving back into X's, but at this point sitting around that 290 range, support at 280 as well as at 272, still maintaining that 5 attribute rating. In response to some of the AI news related to Google, we're seeing some of the major semiconductor stocks move a little bit lower this morning. Again, not major reactions, but we're at least seeing them trade lower this morning. So it could be a combination of sort of broader market move down lower, but something to keep an eye on, as quite a few of these have seen reversals into O's here recently, are coming down to test potential support levels. Micron Technology, one of those. MU has support here at 360, but we did see additional action on its chart yesterday, falling down to 372. Beyond that 360 support, you have support at 332 and 324. Another one where we saw a pretty decent amount of action yesterday and even a little bit this morning. SanDisk, SNDK, still a 5 for fiber. Did see it return to a sell signal with yesterday's action, dropping below 672. There's a fill at a 6.
Okay, that's enough on stock-specific ones, but lots of positive news on the indicators there, so that's encouraging. Let me just go on to sharing my entire screen now. Okay, I should be able to jump around better here. Michael Kuhlbaugh must be away this week on March break with his kids, so I'm going to go through the our value investment partners down in Australia. And this literally just came in overnight, so I haven't had a chance to go through it yet. So let me go find the PDF version. So I'm just going to jump through it really quickly and see what they have to say. So we've been talking about this lots in the past. The petrodollar in trouble, meaning that there's lots of evidence that many parts of the world don't want to deal just in the US dollar only. And so there's some risk of that potentially going away. The US will fight that tooth and nail. Okay, here's some topics here. They're going to talk about the NASDAQ, asymmetry in motion, some lessons in history. I'm just going to have to go through this very quickly. Predictive programming. If anybody on this call wants a copy of this, I can share it with you. So let me know. And then they always come up with 5 or 6 names, pure value names to look at. And occasionally we find a name out of there that we might want to look if it meets all of our parameters. So it looks like he's doing some technical work on the NASDAQ here. Okay, that's a Mag 7 investor. And okay, so he's just going to be talking about running some options on there because it's such a sideways market. If you wanted to earn some income, you could be writing some puts against it. We don't do that, but for individuals, it is something that if they have the time to do it, it can be beneficial. Trading ranges. So this is on the XOP, completely broken out. That's the oil and gas ETF, and up to $160 in price. Fortunately, that's not the price of oil per barrel yet, but same thing there. It's back up to its old peak. So we might find it rolling over, much like Andrew Adams' comments there that Joe stated, that maybe we've come to the end of its run here. Asymmetry in motion, Iran's missile math, $20,000 drones take on $4 million Patriots. Like I say, I'm going to have to read this, so maybe I'll review it. Anything of interest here next time we meet. Yeah, they're getting into all the details and the math behind these. And yeah, there's a stock that's had a great run up that produces these. Yeah. A lot of political posturing here. Let's hope that cooler heads prevail. He loves getting old pictures like this. I'm just going to jump through page by page now. Trump getting on anything he can to get his message out there, rightly or wrongly. I must say he does like to communicate. Yeah, okay, there's not a great deal that I can go through here other than just on the war and some of the outlier benefits of it. Yeah. Yeah, this is as you can see, it's a deep dive. It's 55 pages. So if you want to get a copy of this, just reach out to me. I'm going to keep moving on with the markets. So look at that. Everything on the year to date, except for Canada, has gone red. Japan is the leader there at almost 7% for the year. We're running at about 13%, many of our accounts. So we've got the right things in place right now. And India, we do have a small starter position in India that we'll be having to add to at some point in time. They're really getting nailed right now because of their lack of oil being able to get to their market, and that's obviously hurting many parts of their stock market. When I look at crude oil, it's up 60% year to date. It has started to turn a little bit red there in the short run, so that's encouraging. Just for, no one wants to see oil go like this. It's just a global tax on everybody, and can be very costly for, and it brings on recessions too, as Gilbert will probably undoubtedly show on a chart coming up. Nat gas also in the red, so has not been following oil, even though it's being shut in many parts of the world. Gold's taking a bit of a rest here, only up 4% year to date, silver up 2%. And copper is red across the board. I'll cover the Canada US dollar as I always do, and interest rates with the playbook here. And then I know what I was going to do before the playbook. I did wanted to talk about John Williams and his shadow government statistics. Unfortunately, our subscription, I've noticed, is just expired, so we'll be renewing that. And this is his cover page for his website. It's a little out of date, but basically what this gentleman has done ever since the 1990s, even back to the 1980s, you can see on the cover page of his website, is he's gone back and restated what real inflation looks like. I forget the dates. I think it might have been around 1990. The Bureau of Statistics, the Bureau of Labor and Statistics, BLS, went and reformatted how they would calculate inflation, because they found it was too expensive for the staff of 4 people that were running it back then. This is all John Williams' words that I've learned over the years from him. So the bottom line, the red one, is what the government is calculating, U.S. government is calculating as inflation. And the top blue line is what John Williams has recalculated. And I've reached out to him to get our subscription going again. I'd also like to talk to him about what his current thoughts are on these things. But what I did find in my inbox is, it's February, it's a little out of date, but not too much, is his ongoing calculation of where inflation is. So on the left side is the government's calculation there where my mouse is, and that is John Williams' calculation on a monthly basis. And on an annual basis, that's what the government's numbers that we get quoted every month. And this is what John Williams is. And so let's just carry this forward to 2025. And there we are. So he's got it running at over 10% inflation versus the 2.71 that's being being publicized. I believe it's somewhere in between those numbers. Don't know exactly, but I just know it's running higher than 2.71%. People who are sitting on cash and money market funds and even safe treasury bills are still underwater when you're comparing against inflation. So that's a real thing. We just can't tell you exactly what inflation's running at. It's anywhere between 2.71% and 10.7%. I would say closer to the higher number there, but that's just my hunch. Love to hear feedback from anybody else on this call later. And then finishing up on the playbook, we keep all sorts of statistics here, 80 different ones, everything from cross-currency rates around the world to commodities, to interest rates. And I'll just go through the ones I like to cover every week. So our Canada US dollar is at 72 cents, and both the short-term indicator has it going down to 71, so being the same, or even going lower to 62. So there's there's a lot of challenges in Canada, and politics isn't even part of it. It's really just the economy is very weak right now. We're the weakest in the G7, and it's quite sad that when you compare us to our trading partners and neighbors. Whereas the US dollar has come down tremendously. It's been pushed down ever since Trump's been back into power, just like he did in his first term. He did the same thing. Last year, the US dollar relative to a basket of currencies was down 12%, which is a huge move for the largest currency in the world. So it's at around 100 now, and it looks like it's going to be pushed back up to 110. So that'll put some pressure on gold, but it'll also put downward pressure on our Canadian dollar. I'm not going to cover any more currencies right now. Let's go on to energy at $90 right now. It looks like it's peaked out and it's moving back down below 70. Nat gas is also under pressure. And as Andrew Adams said, it's a little late now to be buying all energies, but there's certain ones that there's still some pockets of stability and definitely nice dividends. But the producers here at 1275 and measured down to 1150. And when I say measured down, this vertical price objective is a mathematical calculation. It's not 100% foolproof. Nothing is in this business, but it does give an idea of the trend of things. Copper up slightly. Uranium is back to being up quite a bit. That's good. We own uranium in a big way and still believe in it. Now gold, back down to 4,500 right now on the futures and a little bit less than that on the spot price. Only the spot price has a higher price right now. So gold is definitely in flux. The producers, though, measure up, so there's still upward momentum in the producers and even the juniors. Silver measures down, but the silver producers measure up, with the juniors and silver looking like they've had their run already. Bitcoin and the crypto space is miserable right now. Bitcoin's at 71,000, measures down to 22,000. Ethereum up. I think I saw Ethereum up big this morning, and Solana up. So the whole crypto space, except for Bitcoin, it looks like it might be turning itself around. The money center banks in the U.S. Look strong, but the regionals look weak. And so we'll have to check in with our regional bank manager in the U.S. to see what they're saying. Maybe this is just a time for more consolidation with the prices suffering. Canadian banks look very strong. And then finishing up on interest rates, got a very strange looking yield curve. Right now, the 2 years at 390 measures down to 275. The 5 years at 397 measures up to 5.1. And the 10-year is at 433, measures up to almost 5%. So both the 5 and the 10-year are measuring up. And now so is the 30-year. So this is another clear indication that inflation has not been defeated. It's still out there. It's still real. The only curve that the government's involved with is the 2-year. That's when you hear about rates being lowered or raised. And now they're talking about raising the short rate. That helps curtail inflation, but they're going to have to push it up an awful lot to really break the back of inflation, in my opinion. Okay, that's it for me. Chris Curry, do you want to jump in and say anything?
Sure, I'd be happy to, Dave. Thanks. It's been a tough market for sure in the rates market. The long end in the U.S. is down about 4% in terms of total return. We're looking at about the same in Canada. You mentioned the Canadian dollar, and it's sort of surprising, being usually looked at as a petrocurrency, but I think that's evidence of a flight to quality. People are just selling, basically any asset that's not U.S. dollars, or maybe they're going to a bigger a different larger currency, but Canada being certainly a middle power at best is really suffering. So Canadian dollars down about 7.5% this month, and I do want to mention, the Atlanta GDP now number is really trailing down. We're down to 2% growth for the next quarter. That's their model. And lastly, I wanted to finish off on interest rate forecasts. These are the, market-based forecasting models. Canada, we've actually, Canada's weird. I mean, this. Maybe I'll talk about the U.S. first because that makes a little more sense. U.S. was at two cuts in terms of the Fed forecast and a lot of market-based forecasts. Those are all gone, so we've got no cuts in 2026. We now have one cut in December 2027, but that's so far out. It's really non-consequential. But, let's go back and look at Canada. The implied forecasts are for rate hikes, but I just don't see, the Canadian economy being able to tolerate rate hikes. So, a 25 basis point hike in September, I can't see that. I mean, that would just cause too much pain in Canada. We're already, suffering, as Dave mentioned, quite a bit, and a hike is, not gonna help the economy at all. And on that note, I'll pass it back to Dave or to Gilbert.
Thanks, Chris. Did Paul Beatty make his way on? Yeah. Hi, Paul. What's going on from Montreal's perspective?
Nothing good, right? As Chris said, tough markets. Can you guys hear me, by the way?
I can hear you, but we can't see you.
Okay. So, my camera is not happy for some reason, but anyways, what can I tell you? We're struggling with these markets, trying to, trying to have a investment theme or two that might last for a week, because it's just like every day the reverse happens. And yesterday was a nice up day and in all sorts of hard assets, and today it's all reversing. So I mean that seems to be what's happening every other day. Very, very challenging to figure out what a longer term theme is, right? So anyway, but what can I tell you? There's opportunities everywhere. We think all sorts of stocks, particularly here in Canada, are cheap, very cheap, really. And we've got I think it's 40% of our fund now is trading at less than 4 times EBITDA. I don't think we've ever had that low a multiple over that big a portion of the fund. So we're just chipping away at these stocks we think are good value. So, but it's we've lightened up. I mean, I think you have to. Who's got high conviction on anything with the war, right? Nobody can predict what's going to happen with Iran. So how can you have high conviction on all sorts of stuff? And so you have to take some money off the table for sure. And I'm sure everybody's doing that, right, to a certain extent. And so reducing exposure somewhat. But the other thing is selling May and go away often happens in Canadian small cap anyway. And so, look, we're into April next week. I think the summer's probably going to be one of those years where you'd like to lighten up on the smaller cap stuff, or you would have liked to have lightened up more, I guess. So that's what we're doing. We're gonna go up market in terms of market cap, and yet we're not giving up much, right? Because we still find lots of larger cap companies trading at good value. So that's what we're doing, and we don't have a lot of answers for what what we should all do. I think it's going to be a little rough and tumble over the next, call it 6 months, would be my bet, and then we'll be, we'll have great opportunities in the fall, right? So lighten up now and into, I don't know, reload in October for a run November, December, January is kind of what we're thinking. And that's it for me.
Okay. Thanks. Gilbert, you want to wrap things up here?
Yeah, absolutely. Let me just share my screen here. All right, so this is this week's short report for Thursday, March 26th. Here's the disclaimer here. Again, long-term S&P 500. This is the long-term support level that's been support ever since the start of this bear market. And if we are going to see some sort of a negative fallout, increased negative fallout from this Iran war and any fallout that comes from it, a longer-term support level, if we get there, would be at this line, which is around 5,500. Taking a closer look, we've been taking a look at this sort of sideways action since the end of last year, and we're now at a point where the S&P 500 is actually at the same level it was in September. So moving all the way down. And again, we're pointing out the similarities between the current move and what we saw at the start of 2025. Again, not predicting that we're going to see a crash like this, but again, as everybody's pointed out on this call, there's nothing that you can predict when you have somebody who's tweeting at all hours of the night, things that could change global policy. When we take a closer look, again, we're flirting with this 200-day exponential moving average on the S&P 500. Last time we did that, unfortunately, yes, again, that was the start of 2025, which saw a strong move lower. And so I think investors right now are a little cautious looking at history and saying that, maybe now's not the time to load up. As Paul pointed out just now, yeah, we're probably going to see some increased volatility and a lack of opportunity until maybe the end of the year or later in the year. And this is always a possibility here from a technical perspective. The CAPE ratio, we pointed this out, rolling over from levels that we hadn't seen since the dot-com bubble, and rolling over in similar ways to what we saw at the start of 2025.
Right, Gilbert, just explain to people what CAPE stands for.
Cyclically adjusted price earnings. So this is essentially a PE ratio that's smoothed out based on cyclically adjusted. So it's just a smoother way of looking at PE ratio. Whereas if you don't use this, you can get some anomalies, especially in 08. PE ratios exploded higher, but that doesn't really make sense. And so this is just a way to smooth out price to earnings ratio. So hope that explains that. So we can see it's starting to sort of roll over at this point. Credit spreads. So this is something I've been taking a look at for a long time. So this is high yield index options adjusted spread. So this is the spread between government and corporate high yield bonds. And so what we have here is again, just a move into this very tight area, which has now been sort of unwinding and moving higher. The good news is that it's been doing this in a sort of slow and gradual manner, which is what we've seen expressed in the S&P 500. We haven't had huge down days, huge volatility spikes. We've just seen the market sort of slowly roll over. Similar to what we saw really at the beginning of 2022 before things really started to get messy there. The point that we were going to make with this credit spread chart again is that every time we get down to this level where spreads are tight, there's typically not a lot of upside left in the market. And that's what we've seen historically. Defense versus growth. Yes, there has been a little bit of a rotation back into growth after the software sort of massacre that we saw at the beginning of the year. But this doesn't look like it's something that's going to continue this way, similar to what we saw again in 2022 and in 2025. The similarities just keep adding up. Joe pointed out market breadth at the beginning of the call. I think he was looking at the NYSE stocks trading above their 50-day. This is the S&P 500. Again, we've gotten to a low point here and we've seen a little bit of a bounce, but longer term, what we typically want is sort of a flush out here with this reading getting well into the 20s, even in the teens, before we can call a strong bottom. And one of the reasons why is because when we look at broader breadth, so stocks trading above their 200-day moving average, we can see that we're not at this flush out level here, which is typically under 30% of stocks. We've just come down to about 50%. So, maybe a near-term bottom, but not necessarily a long-term bottom. And that's why we're concerned about, more downside when we take a look at the longer-term S&P 500 chart. David pointed this out earlier. I just want to point this out again, just the relationship between oil and the S&P 500. Every time we see a spike up in oil, at least over the last 25 years, a spike in oil above $80 a barrel, that is followed by a strong decline in the S&P 500. We've seen this in 2008, 2011, before COVID in 2022, and now what we've seen is a big spike in oil above $100 a barrel. And it makes sense why this would be the case, because margins start to get compressed, the consumer starts to get strained, and that trickles out to every part of the economy. Another thing that I really do want to point out here is that while everybody's focused on the Iran war, underneath the surface, we can see U.S. unemployment continuing to deteriorate over long term. And you're not getting these big headline numbers like, a decline of 500,000 jobs. In Canada, we had a decline of 80,000, which the U.S. equivalent would be just about 1 million jobs lost. We're not getting those numbers coming out of the U.S., but we are getting a deterioration in non-farm payroll growth, which is typical of what we see before recessions, historically going all the way back to the 1950s, right? We've seen U.S. non-farm payroll start to flatten out here, and typically when you get a flattening out, that's followed by a decline. This is year over year non-farm payroll growth, and you can see that since the pandemic, or at least since the reopening, we've been positive, and we're now right at this zero level in terms of year-over-year growth. Typically, historically, once we break down into negative year-over-year growth, that is followed by a recession. Same thing with real personal income. You can see real personal income did dip to the negative territory in 2022, and we saw the market suffer as well. But when we go back historically, we can see every time this number declines and then dips negatively, we have a recession in the United States. So if you're concerned about this, about what is happening here in the markets, please reach out to us. We have a solution with our partners at Universa, and we can help you in case of any sort of black swan event. So reach out to us. So that's it for me.
Good stuff, Gilbert. Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.